Physical Gold Fund presents Global Perspectives with Alex Stanczyk and invited guests. We'll be exploring international markets and the complex forces that drive them, including geopolitics, economics, and the global monetary system. Hello, I'm John Ward on behalf of Physical Gold Fund. We're delighted to welcome you to the first podcast with Alex Stanczyk in the series we're calling Global Perspectives. Alex Stanczyk is the Managing Director of Physical Gold Fund. Alex is an expert in the physical gold industry, dealing with the logistics chain from refinery to secure transport and vaulting, and he's lectured globally to investor, institutional, and government audiences on the role of gold both in the international monetary system and in investment portfolios. Hello, Alex.
Hello, John. Great to be here. This is going to be a wonderful conversation today with someone whom I'm a big fan of personally.
I'm sure it is. And our guest indeed today is Brent Johnson. He's the CEO and portfolio manager at Santiago Capital, a hedge fund that focuses primarily on bullion and other metals-related investments. Brent has been creating and managing wealth management strategies for high net worth clients since the 1990s. Early in his career, he was a financial auditor for Philip Morris Management Company, and he went on to serve private clients for Credit Suisse. Brent recognized early on the need for a robust precious metals solution for his clients, and that's what prompted him to launch Santiago Capital. Since then, he's attracted a growing following as an expert on gold. Now in his spare time, Brent devotes himself to educating the public on financial and monetary issues, and his work is often featured throughout the blogosphere, including Zero Hedge. Welcome, Brent.
Hi, guys. Thanks for having me. It's great to be with you today.
And now, Alex, over to you.
Okay, thanks a lot. So let me start out by saying, Brent, it's really great to have you on. One of the things that I find really interesting about you is that you don't really follow the crowd. There's a lot of different analysts in the space, and interestingly enough, and you're probably already well familiar with this, sort of the common theme or the common thing that you see amongst analysts in the sectors is that they all often parrot each other. And I find it kind of curious how that happens, and it isn't so often that you run across someone who's got some original thinking and some original content, and you definitely sort of fit that mold, or you're sort of the person who, I shouldn't even call it a mold, you've broken the mold, who really kind of looks at the whole situation in your own sort of way. So looking forward to what you have to say on a lot of these different levels. If you don't mind, Brent, let's talk a little bit about your latest presentation. Is called Don Yuan. Can you give us like a really quick summary of Don Yuan and what it means to you?
Sure. Yeah, and thanks for the nice words you said. By the way, I'm excited to be able to come in and talk to you, and I've been a fan of you and your work you do as well. So this is a great opportunity. As it relates to Don Yuan, it's really a play on two of the biggest forces I see in the world today, and it's not just market forces, it's political forces and it's social forces, and that's Donald Trump, the Don, and then China and the Yuan. So rather than Don Yuan, I kind of titled my latest presentation Don Yuan, because I really do see those as being the two primary forces right now. And it's kind of a funny play on words, but it's actually a pretty serious topic when you really get down to it. And it's a very divisive topic, but it's an important one. So that's a long way of explaining the Don Yuan title, I guess.
I understand. Let's dig a little deeper sort of into some technical areas that you had mentioned in your other series, Step into Liquid. And one of the things that you talked a great deal about was stock and flow of the money supply. And a lot of people are familiar with this concept of stock and flow, but they may not really understand why the flow part of the stock and flow is so essential and why it plays such a big deal in sort of your framework of looking at the world. Can you talk to us about that and about why flow is so essential?
Yeah, absolutely we'll do that, because it's really kind of the key to everything. And it's funny because I kind of learned this stuff in college, but I probably just learned it long enough to memorize it, to pass whatever test I was taking, and never really thought of the real world implications of it. And then, 10, 15 years ago, I started looking at it closer, and 10 years ago when we started getting into 2007, 2008 timeframe, I took a really hard look at it, and that's when it really hit me. So the stock and the flow really goes back to a debt-based monetary system where money, for lack of a better word, is loaned into existence. And the way that our monetary system is designed has a severe design flaw in it. And you can argue whether or not it was done on purpose or whether it was done on accident. We could probably do a whole hour just on that. But regardless, the flaw is there.
Yes.
And the flaw is that in a debt-based monetary system where money gets loaned into existence, all loans have interest attached to it. So if you loan money into existence, then at the end of the year, you need more money to pay the interest than actually exists. So either the existing money in the system has to be circulating, or the flow, for lack of a better word, has to be flowing at a fast enough rate where that money can change hands and satisfy everybody's interest payment. If that flow is not flowing at a high enough rate to where the interest gets paid, then loans go into default, and because it's like a daisy chain, it starts cascading all the way back to the base money from which that money was loaned into existence to begin with. You know, you look back at all the central banks are like this. They're all kind of based on the same design, but you know, for this argument, let's just look at the United States. The monetary base is around $4 trillion, about $2.5 trillion, or actually it's about $2 trillion. $2 to $2.5 trillion is reserves at the Fed, which isn't flowing. That money just sits there as a reserve, the bank's reserves. Then there's about $1.5 million of physical currency, which actually, so that's money that actually exists. That's the base money. All the other money is basically digital money, ones and zeros that are loaned into existence, and it shows up on a ledger somewhere that says you have this money, and et cetera, et cetera. And so, you know, if you look at the total banking system, the banking system has, well, again, it depends on how you measure it. Let's just say $16 trillion of banking assets. So if $4 trillion is base money, then that means there's $12 trillion of money loaned into existence, and you know, some other assets, et cetera, et cetera. So anywhere from 10 to 12 trillion is loaned into existence. So there's interest attached with that 10 to 12 trillion. And
right. You know,
if that's right, and so if that money isn't circulating, those loans go into default, and you can think of it similarly like a collateral account on a brokerage account. If you buy on margin and whatever you buy doesn't go up, then the equity gets eroded and you have to resupply the collateral, or else the whole account fails. It's very similar. If GDP and money velocity is not high enough that there's not enough transactions going on to satisfy all those interest payments, well, then the Fed has to come in and plug the hole and, you know, add money back to the collateral, which is the base money. And so, and so that's really the stock and the flow. And if you look at the velocity of money, it really started in the late 90s, probably around, you know, this would be a great question for, you know, Jim Rickards, who I know you're very close with. You know, it all started around the 98 crisis when long-term capital management, the Russian debt crisis, and the Asian currency crisis. You can look at the velocity of money, and going back there, it's just been on a downward slope ever since then. Now, there's been a couple times where it, you know, turned back up for a year or so, but then, you know, just turned right back down, and we've been in this downward motion for 15 years now, 16 years now, almost 20 years now. And you can go back and you can look at the reserves at the Fed and the base money, and it's ramped up since then. And there's a direct correlation. If money is not moving, then they have to continually fill up the collateral, and that's the essence of the stock and flow. That's the essence of the flaw in our monetary system. The other part of it is that if the money is circulating and there's no problems, the interest attached to it, even if it's just 1% a year, it becomes an exponential system. It doesn't matter. You can start with number one. If you take 1 times 1.01 year after year after year after year, it will eventually go exponential. It'll turn straight up, and it'll, you know, and then you get the inevitable blow off top that ends with a magnificent crash, right?
That's the hockey stick on the chart, right?
Right. So, exactly. So it doesn't really matter whether or not the money is flowing or whether the money is not flowing. That design flaw of the money loaned into existence is a catastrophic flaw, and it's bound to fail. It's just a matter of time.
And we're not talking about philosophy here. This isn't about whether this monetary system or that monetary system is a better thing, or a gold standard is a good thing or a bad thing, or whether Keynesian is a good thing or a bad thing. We're talking about math right now.
You know, if you believe in math, buy gold, because, you know, our monetary system, mathematically, certainty will fail. Right? That shouldn't really be a provocative statement. It's just math. You can argue with math if you want to, but you're going to lose.
You're going to lose. Absolutely. I totally agree. And that's something that I think a lot of people don't realize about our monetary system. I think there's a lot of people caught up in this argument about it, whether Keynesianism is a good thing,
right,
or whether the gold standard is the way to go, or whatever, all those kind of things. And, you know, I'm not going to argue that one way or another right now, but I mean, if you just think about the math, that's really critical. People need to understand that it's going to change. It's only a matter of time. All right, so
exactly.
Let's move on a little bit and talk about regulation. And
sure,
that's been kind of a big topic for the current incoming Trump administration, and I'm sure for business owners for decades now, or at least going on a decade and probably longer. The amount of regulatory creep that's been occurring has been getting more and more intrusive, and really not just in the United States, but globally. I mean, from a global perspective, our fund operates globally. We've done business globally for a real long time. And we've seen the regulatory creep effect there and how that's affecting things. What do you think is going to happen as this creep continues to impact the banking system? And, like, how can this be a big problem?
Yeah, well, boy, that's a big topic. I mean, there's a lot of different ways it can be a big problem. There's probably one area that I can focus on that kind of will help explain it in a somewhat simple manner. You know, if you think back after all the problems that happened let's call it between 2006 and 2010, right? The run-up in the real estate bubble, the explosion of the real estate bubble, and then all the ancillary negative effects that happened for the couple years after the bubble popped, right? You know, the banks did a number of things wrong, right? And we can just leave it at that. We don't have to get into all that detail right now, but they did a number of things wrong. Yeah. The public bailed them out, perhaps rightly so. The government said, well, we got to go in and do something to make sure this doesn't happen again, right? And like all good government programs, they maybe start off with good intentions, but they end up with a really bad result. And one example is that, you know, the Basel III Dodd-Frank requirements that are now imposed on the banks. It makes sense. The whole goal of the Basel III comes from Basel, Switzerland, where the Bureau of International Settlements sits. That's essentially the central bank's central bank. So they are trying on a global coordinated basis to establish a framework through which all these other central banks and governments and monetary authorities can craft a global solution to keep this from ever happening again, right? And again, starts off with good intentions. But, you know, the one area that we can use it as an example is they thought, well, we need to make sure that the banks are adequately capitalized so that if we ever have another downturn, they don't go through this big liquidity event where their, you know, capital evaporates and the public has to bail them out. In theory, it sounds pretty good. The problem is getting all these different countries to agree on the same thing. And then, of course, politics comes into it. They do things like they say, you can hold these different securities on your balance sheet, but they are all going to have different ratings. Well, of course, they give their own debt, the country's debt, a zero risk weighting, right? You can buy a Greek bond, a Portuguese bond, a U.S. bond, or a Chinese bond, and they're essentially all given a zero risk weighting, which on the face of it is ridiculous, right? But that's the rule. So the intention is good. That's just one example of where now banks can hold risky assets on their balance sheet, and it says they don't have any risk at all when in fact they're carrying a lot of risk. Especially when you look back and, you know, I don't know if there's ever been a country in history that ever paid off its debt without inflating it away, right? So the fact that you take the one entity, which is a government, which has never made good on its debt, and you give it a zero risk weighting is, you know, in my opinion, it's a bit ridiculous. But that's just one example. So, you know, let's take a little bit further. So in the U.S., you know, the framework under the U.S. under which, you know, kind of bubbles up to the Basel III Accord is the Dodd-Frank. And one area in particular that they took a look at was money market funds. And, you know, for several years they have said by October of 2016, money market funds will no longer be able, they will have to mark their book to market. Basically what that means is for a long time, you know, these money market funds were created as a way to provide short-term financing for banks and other big corporations. It's almost like cash. So, you know, people that are invested in it, they kind of assume that it's cash, and so it always just keeps a par value. So if you put $1 in, it shows $1 on your statement, right? But in actuality, these are bonds underlying these money market funds. Now, very short-term bonds, but they're bonds, and there is risk. And occasionally, especially like in 2008, there were some failures, and some of these money market funds broke the buck, so to speak. So they actually printed 99 or 98 rather than 100 cents on the dollar. Well, in their infinite wisdom, the government said we can't have that anymore. We can't, we'll give you a few years to get on board, but by October 2016, you're going to have to market these funds to market. Well, that was the case for prime funds, which are corporate-backed funds, but not government funds, right? The government doesn't have to mark their books to market because, we're the government, we're never going to default, and we don't have any risk. So what you saw as a natural progression is people who didn't want to take that risk, they left prime funds, and they moved all their money into government funds. And so there's been a big sea change from prime funds to government funds, which perhaps on one level that's good, but the problem is now you've got even more people huddled and concentrated in one area, again, government funds, which in my opinion have, in many ways, maybe more risk than a AAA-rated corporate bond does, right? So that's one example. Not only that, but a lot of the banks that they're trying to protect against, they used to get their short-term funding from these money market prime funds. Now that those money market prime funds are gone, they don't have that competition. They don't have that, there's no competition between prime funds and prime funds anymore. So, that they've lost one area of financing, so the cost of financing has gone up. So you can look at things like LIBOR. You look at LIBOR between July of last year and October of last year, and it almost doubled. And it's basically because a big part of it was because of this movement in the money market fund. So now you've got a higher concentration of funds, a higher cost of funds, and a lot of people concentrated in an area that perhaps has more risk than they otherwise think it has. So that's just one example of how regulatory good intentions end up being long-term bad solutions. That's probably the best, easiest way I can explain it.
Thanks, Brent. It's John here. So just talking of concentration, do you have any observations about the whole phenomenon of too big to fail, of the largest banks simply getting larger and larger, and in that respect becoming kind of unassailable?
Yeah, I mean, it's really true. I mean, and you've seen these banks get bigger and bigger, right? And I don't have the market caps right in front of me, but they're much bigger now than they were in 2008. If you total up all the fines that the banks have paid between 2008 and 2016, it's something like $300 billion. Now, name me another industry where the bank, where that industry can pay $300 billion in fines, still be in business, and still have their profits going higher, right? Another part of it is you don't pay $300 billion in fines if you're treating your customers well, right? So what other industry can do that to their customers, stay in business, and grow? It's kind of ridiculous, crazy, right? I mean, it's, on the face of it, it's just absurd. Where this is another example where this is becoming a problem is as these banks have gotten bigger, as regulations have gotten more intense and more severe, the part of the reason the big banks have gotten bigger is they're the only ones that can afford to hire the lawyers to comply with all these rules and regulations. And so maybe these smaller community banks or regional banks that didn't have anything to do with the problems that caused 2008 and 2009 are the victims of it because they've now had to implement new regulations and procedures, and they've had to hire 10 lawyers instead of one lawyer, et cetera, et cetera. And they basically just can't compete against the big guys, so they either go out of business or they sell to the big guys, and the big guys just get bigger again. And not only that, then you've got a big national bank perhaps, representing a small, manufacturing facility in Dubuque, Iowa. You know what I mean? And the big national bank has no idea what goes on in Dubuque, Iowa. So maybe they can't even make that good of a decision of whether, that company deserves better credit or worse credit or a loan or, you've gone away from community banks serving, small businesses to these big mega banks trying to write, rules and regulations that apply, black and white to everybody when it's really a gray world. So I see big problems with all these regulations. I'm a free market guy. I think the free market solves all the problems. And people say, well, yeah, but if you don't have regulations, then, all these banks would have gotten away with murder. Well, no, they wouldn't have. They would have been bankrupt. They would have been gone, and the problem would have been solved. So cute way of looking at it, but I still believe in capitalism.
And you know what? This is an area, Brent, where you and I think we largely agree. And the problem, as you mentioned it, as you explained it, even feeds on itself because it's sort of like raising the cost of entry into the market by creating all these regulations so smaller businesses really can't compete. And the problem with that, obviously, is if there's no competition, then there's nothing that's going to be keeping these guys honest if they can get away with it, right? So,
right.
That's a big deal. If we can circle back around to our earlier topic for just a minute, I think that it might be helpful for our listeners to know a little bit more about velocity of money and what it means. So not everybody understands that. You and I, in the industry that we're in, we get that. We understand what that means. But, as far as velocity of money, last chart I looked at from the Fed, the current velocity of money it hasn't been this bad really since probably maybe 1971 or 72. It's absolutely horrible. I think sometimes people wonder, well, since the last global financial crisis, we've printed up trillions of dollars. Those dollars have been injected into the economy, but we aren't really seeing inflation. And see, all the Keynesians are coming out going, look, money creation doesn't create inflation after all. But what the part they're leaving out is the whole velocity part. So what does that mean? I mean, what happened there? We had all this trillions of dollars injected into the system, but we really haven't seen much inflation. What's going on with that?
So, there will be people out there that will say, what are you talking about? We've got incredible inflation. House prices have doubled. The stock market's tripled. When I go and I buy, my Thanksgiving dinner, it costs me $150 rather than $89, right? So I think there has been inflation, but it's actually been more, and while there has been some consumer price inflation, in general it's been more asset price inflation than consumer price inflation, right? And a big part of that is again, part of the way the monetary system is designed. The way it's designed is the central banks give the banks the money, then the banks give the money to Main Street, right? There's not a system where it goes from the central bank to Main Street. And the mechanism by which it goes to Main Street is loans, that money creation that we talked about earlier. Well, if you look at if you look at all the QE that we've done, the quantitative easing, the bailout packages, et cetera, stimulus packages, however you want to define them, it was done as a way where, the central banks bought assets from the banks, and in exchange for taking those assets from the banks, they gave the banks cash. Well, the banks did not then loan that out into the market at the rate that the central banks were hoping that they would. Now, you can make a big argument. Did they not loan them out because they didn't want to loan it out, because they wanted to keep it for themselves and collect interest on it? Because they actually get paid by the central bank just to hold on to it. Or was there no demand? Was the consumer so tapped out that there was no demand for the loans? And I think that could probably be a whole other hour topic on itself as well. But regardless of whatever the reason is, that money did not flow to Main Street. And that is when I was talking about earlier, as velocity fell, the reserves of the banks at the Fed increased. I mean, it's almost a one-for-one correlation. Now, a lot of people will say, that's not, and that's why we haven't had inflation, and you shouldn't worry about QE because it's not inflationary, because it's just sitting at the banks. Well, technically, that's correct, but it's very disingenuous, in my opinion, because the reserves at the Fed is what the banks use as collateral to make new loans. So even though they haven't made new loans yet, they've got $2 trillion in reserves now that they didn't have 10 years ago. And on a 10-to-1 reserve to loan ratio, they need to keep 1 unit of reserves for every 10 they loan out. $2 trillion of reserves could actually become $20 trillion in new money. 10 years ago, the monetary base was $800 billion. Now it's $4 billion. And on reserves of $2 trillion, they could loan another $20 trillion into existence. The total banking system assets right now are around 15 or 16 trillion. So they could essentially double the size of the banking system on those reserves that have been given to them in the last 10 years. So if and when that happens, that would be highly inflationary. So it's kind of like a dam being built, right? And so, we have all this liquidity flowing towards Main Street, but the banks built up a dam. And all that flow, all that money from the Fed just kept building up behind this dam, and it kept getting bigger and bigger. And now there's a big lake there. That's the reserve, right? It's become this huge lake. Well, if that dam ever breaks, or if they ever open the levees on that dam and start loading it out, well, that can lead to even higher pressure of that flow coming out, right? And that can lead to even higher inflation if and when it happens. So now I can't tell you for sure it's going to happen. I actually think it is going to start to happen for reasons that we can get into in a little bit, but those reserves that have been built up that everybody says, see, these aren't inflationary. They're the tender for the inflationary fire that can come later.
I totally agree. It's interesting because when there's no velocity, in other words, people aren't spending money, loans aren't being made, then that creates what you were talking about, that big sucking sound in the flow of money. And they have to continually add more dollars to the system to make up for that sucking sound, which is really only making this lake bigger. So
bigger, no, exactly. And so you've really touched on the key to everything. The key to everything is the velocity of money. It really is. If the velocity of money picks up, then you're going to have inflation, and maybe this flawed system can go on a little bit longer. But if they cannot get the inflation if they cannot get the velocity to pick up, then inflation's not going to pick up, growth is not going to pick up, and we're going to be back to this deflationary debt spiral. It all hinges on the velocity of money.
Yeah, and here's another interesting aspect of that is that velocity, what a lot of people don't realize, is closely tied to psychology. And one thing that is guaranteed is that the psychology will not stay the same forever. So it's almost like a perfect setup. Like the psychology is going to shift at some point, and when it does, it's like we're set up to unleash that gigantic dam. That's
exactly right. In many ways, inflation is more psychological than it is economics or math. I mean, it's just pure psychology. And this is where I think the Fed has really gone wrong. And this is where I think I alluded to this in one of my recent presentations, where I think the market bailed the Fed out. What I mean by that is, if we go back 9 months or 6 months to 9 months, or let's go back a year. The Fed, raised interest rates in December of 2015 and indicated they were going to raise 2 or 3 times in 2016. Well, got into spring of 2016, they didn't do it. Got in further into the spring and they didn't do it. Got into the summer and they didn't do it. Got into the fall and they didn't do it. Right, and so they were rapidly losing credibility. Not only that, but in Europe they tried negative rates, and in Japan they tried negative rates. So all this talk of they were going to raise 3 times and they couldn't even raise once, right? And so, but yet they were like the little boy that cried wolf. They kept saying it's coming, it's coming, it's coming. Well, in the summer and in the fall, the Fed kept saying we're going to go slow, we're not ready yet. But the market, and maybe that was psychologically driven, started to say, you know what, negative rates are ridiculous. Interest rates are at 5,000-year lows. We're at negative to 0% interest rates. Do we really want to be buying bonds at negative interest rate out 50 or 60 years? I think the peak was, it was in August or September. I think Austria issued like an 80-year bond at a negative rate.
Wow.
And it's just absurd, right?
Yeah.
And so, but then there did start to be some growth prospects pick up. Some inflationary signals started to pick up. And then, Trump won, and Trump's policies, I believe, are inflationary policies, and I believe it for a little bit different reasons than a lot of other people believe it, but I think they are inflationary policies. And so into the last into the last 60 days before the last Fed meeting of the year, rates really started to rise, stock prices really started to rise, inflationary pressure started to rise, and I think that allowed them to raise rates. And in that way, I think the market front-ran the Fed and allowed the Fed to raise, because I'm not really sure the Fed wanted to raise, but I think they had to raise. And this is going back to the psychology. I think for the last 2 or 3 years, with the Fed saying, we're going to keep rates low, we're going to keep rates low, and other central banks saying we're not going to keep them low, we're going to go negative. This is their ivory tower working at some PhD economics department psychology, telling them if we lower rates, people will borrow more. Well, I think in the real world, the central banks are supposed to be the smartest people in the room, right? They're supposed to be the financial geniuses. Well, if the financial geniuses are telling me that things are so bad that we're going to have negative rates, why the hell would I go take out $1 million loan and build a new plant? Why the hell would I hire that new person if the smartest people in the room are telling me things are so bad, we have negative rates?
Yeah.
I'm just going to wait, and when things finally get better, then I'll hire. I think that low rates and negative rates are actually deflationary, as opposed to the ivory tower opinion that it's inflationary. And now that rates started to pick up and the Fed raised, I think the market bailed them out, and I think for them to keep this momentum that they've got to keep on the raising of rates train. I mean, I think if they now go back and say, oh, we're not going to raise anymore, we're going to slow down, and then I think they lose all momentum and we go back into that deflationary environment. Because from a psychological perspective, if you've been sitting on this cash and you've been waiting for the time you haven't built that plant, or you haven't hired that person, or you haven't invested in that new project because rates are low, or maybe even going lower, maybe even going negative, and you're saying to yourself, I'm just going to wait till we get through this and things get a little bit better. Well, now if rates start to rise, maybe on the first rate rise you don't do anything. But on the second one, you're probably going to start, maybe things are getting a little bit better. By the time the third or fourth raise comes along, or by the time the market takes interest rates higher, even if the Fed doesn't, now that CEO or that asset allocator or that investor says, holy cow, things are starting to take off. I need to make a move. And then you start to see that velocity of money pick up, and then it kind of becomes a self-fulfilling prophecy to the upside. So I think that the market, and then that's where I think Trump comes in. I think Trump is such a wild card that psychologically he may change behavior in the market. Mm-hmm. Not because he's magic, and not because he's our savior, not because he's this new found hope that America is going to be great again. He's going to do things differently, rightly or wrongly. He's going to do things differently. He's going to put some policies in place that I think are inflationary. And I think if the central bank follows, quote unquote, his lead, for lack of a better word, and continues this upward projection of interest rates, then we might get some change of behavior, and we might get that velocity of money pick up. And with all those reserves that have been built up, inflation could pick up rather quickly.
Brent, can I ask you just one thing about Trump? You mentioned that you, like many people, see his policies as inflationary. I think for most people, they're thinking about his plans for massive infrastructure spending, but you indicated you had a slightly different angle on this. Could you explain why you think his policies are inflationary?
Yeah, and this is probably where I start to differ from the typical market observer, or maybe even the typical gold investor, for lack of a better word. I think the typical view, and look, I don't want to speak for anybody else, and I'm certainly not trying to put words in anybody else's mouth, but I think the common view in the precious metals community is one of the main reasons you buy gold is that fiat currencies are fundamentally flawed. The governments will print them to pay for their bad debts, and that currency will be inflated away, and so you need to own precious metals as a way of protecting that purchasing power. And that's certainly over the long term a very valid reason to own precious metals. It's maybe the top one reason to own them. That said, I don't think that is the best reason to own gold right now. I think it will be in the future, but right now, I actually think that Trump's policies are inflationary because I think it's going to lead to a stronger dollar. And I think we're going to be in a unique point in time where the stronger dollar leads to higher inflation. I know that sounds a little off or different, but and let me explain to you why. So I actually believe that we're going to get into an environment where the dollar and gold and potentially even the Dow are all going to rise together. I don't think we're there yet, but I think that's what's going to happen in the years ahead. But there's a window of time that we need to go through to get to that place. I think the strong dollar is here. Now, it may weaken a little bit over the next month or so, or maybe even over the next quarter, but I don't think it will, but if that were to happen, I think it would be a short-term thing. I did this presentation over last summer that talked about, I called it Step into Liquid, that listed all these different reasons that I thought the dollar would get stronger. I'm happy to share that with anybody that wants to see it, but I think the Trump policies are going to make that thesis that I had even stronger, and here's the reason, is that like it or not, the world is still on a fiat system. And like it or not, the dollar, as flawed as it is, and it's extremely flawed, is still the world reserve currency. And it will be the world reserve currency until the moment it's not. And so regardless of how you view the dollar, institutions, countries, companies, corporations, people who trade, people who import and export, they need dollars to facilitate world trade. If you look at all the dollar debt in the world, we go back to this debt supercycle. I mean, there's hundreds of trillions of dollars of dollar debt in the world. Let me just give you a couple numbers. And so, long story short, I think the supply-demand issue on the dollar is going to push the dollar higher. I'll get into the reasons why here in just one second. A lot of times people will say, yes, Brent, but they can print the dollar to oblivion, and therefore they can give it all the supply that they want. Absolutely true, but right now they're not doing it. In fact, they're doing the opposite. They're decreasing the amount of money in the world, they're raising interest rates, and they're sucking all that money back into the U.S. as opposed to sending it out to the rest of the world. Now, if they change course, then fine, but right now they are not doing it. If you go back to the supply-demand issue, there's, like I said, hundreds of trillions of debt in the world. So let me give you a few numbers. If you look just at the U.S. debt, 20 trillion. The Fed owns 2.5 of that, so let's say it's 17.5 trillion. In addition to that, we talked about the loans in the banking system. The loans in the banking system are anywhere from 10 to 12 trillion. Let's just call it 10 trillion. So you put 10 trillion on top of 17 trillion, now we're at 27 trillion. Now, outside the United States, entities, institutions, corporations, however you want to define them, outside the United States, have issued another $10 trillion of dollar-based debt. So put that 10 trillion on top of the 27 we already have. Now we got 37 trillion. Okay. Now we haven't even talked about, U.S. corporations at this point. So far, we've just talked about the U.S. debt, the banking system, and the international entities debt. So let's just use 37 trillion as an example. Okay. So the average interest rate on the national debt is, I think, 2.25%. $17 trillion, that would be, call it, I don't know, $300 or $400 billion, right? Okay. So then on the other 10 trillion that's in the banking system, let's just assume, for the sake of argument, that they can get the same rate as the risk-free rate of 2.25%, which is ridiculous. But let's just pretend they can. So that's another 250 billion of interest payments. And then we take the international 10 trillion, and let's assume they can get the same rate as the U.S. World Reserve Currency risk-free rate of 2.25%. So there's another 250 billion a year. So now we're somewhere at $700, $800, $900 billion a year in interest payments alone for the dollar. So that is demand. That is $800 billion of demand for the dollar every year just to pay the interest, right? Without the velocity of money picking up, where are people going to get $800 billion to pay their interest payments? Well, the point is that there's a lot of demand for dollars. And we haven't even talked about the demand for trade, for new businesses. But just in interest payments alone, we're approaching $1 trillion a year in global demand for dollars. Now let's bring that back to Trump's policies. So it's a combination of Trump's policies and the Fed. So the Fed, when they were providing QE and they were, giving dollars to the world that would then get, either loaned into the banking system or traded, the banks would use them as collateral to make trades, more dollars were being provided to the world. The spigots were open, for lack of a better word. But now rates are going up. It's costing more money. Not only are we not providing new dollars to the rest of the world, but we are saying it costs more to service the ones that there already is, right? And so, Trump is talking about putting up border tariffs where any goods coming into the U.S., would have to pay some kind of a tax. Well, that means prices are going higher, right? That means, so even though the dollar would get stronger, the prices would go up. Prices of commodities would go up. So now we've got, potentially stronger dollar and some higher prices. Also, if you think about, he has said that he would like to, build a wall with Mexico, for an example. Well, if Mexico, they're not going to want to pay for the wall, but he's going to try to negotiate tougher treaties with them. Now, whether he can do it or not, I don't know, but he's going to try to negotiate tougher treaties. In other words, he wants to send less dollars to them and more, their stuff to us. So the point is that he wants to provide less dollars to the world and more dollars to the U.S. here. Well, that's a strong dollar positive. And if rates continue to go up, which I think they might, and they might not, but I think that for the central banks of the world to have any chance, I think we need rates to rise because that's the only way to get the velocity of money going. Yeah. So if rates go up here and they stay flat in Japan or Europe, or they go even more negative in Japan or Europe, that should bring more, asset allocators should bring more money to the U.S. just to park it in dollars and get some kind of an interest payment rather than zero interest payment, right? So that alone makes the dollar more expensive. Then another Trump policy is he wants these corporations who have these big cash balances to bring the dollars back to bring that cash back to the U.S. Well, if he provides them, the reason they don't is because right now there's very unfavorable tax treatment. If he gives them a one-off, he says, listen, you bring the cash back, we'll charge you a one-time 10 or 15% tax on it rather than the current 40% rate. I can imagine a lot of people are going to bring that cash back. That makes the dollar stronger. So then the interest rates go up even higher. More capital is drawn to the U.S. And then not only that, but as the dollar gets stronger, if we go back to the 10 trillion that the international entities own, it's even harder so basically they took out big loans and they were involved in currency speculation at the same time, thinking their currencies would appreciate against the dollar. Well, now it's gone sideways on them.
Yep.
Now they're upside down. The dollar's getting more expensive.
Yep.
It's even harder for them to service that debt.
Yep.
So they go into a decline, which makes us look even better on a relative basis, which makes the dollar go even higher.
It's a self-feeding process,
I'm trying to make
isn't it?
You can get into this vicious circle where the dollar goes higher. And unless the Fed reverses course and starts providing more, dollars to the rest of the world, then you get into this situation where the dollar gets even stronger. And then you think of places like China, which are going through their own credit crunch, who's one of the biggest owner of treasuries. Well, there's all this money trying to get out of China. And so when the money leaves China, China has to, take the yuan that's trying to get out and give them the dollars, that are leaving. So the way that they get the dollars to give the people that are leaving is they have to sell their treasuries to provide the dollars. Well, if they sell the treasuries and they're the biggest owner of treasuries, well, then that pushes yields up on treasuries, right? So now interest rates are even higher and the dollar goes higher again. So the point is there's all these different forces. Because the world still uses the dollar as the world reserve currency, and because the world still needs dollars to operate, there's a supply-demand imbalance. It's very similar to the gold argument. What's the argument with gold is that there's not that much out there, and when the world realizes that you need gold, the demand is going to overwhelm the supply, right? And then you say, well, yeah, but there's they can just print more, and you can provide. Well, you can't print more gold, right? But you can sure as hell print more shares of GLD, and you can certainly out of thin air create more options and futures contracts on the COMEX, right? So, a lot of times the community will talk about the fact that, ETFs and the COMEX provides quote unquote paper gold, which keeps the price from going exponential, right? And, again, that's a conversation we could spend 2 hours on that topic. The same kind of dynamics currently exist for the dollar. They can do that. They could print the hell out of it and provide as much currency as the world needs. But right now they're not doing it. And until they start doing it, demand is overwhelming supply, or I think will overwhelm supply. So that's kind of my whole Trump is inflationary perspective. I hope I made sense. I know I was rambling for a long time.
No, it makes total sense. Yeah, well, Brent, I think you do some of your best work when you're ranting there like that. That's great. It's a really good argument for a strengthening dollar. And, part of your thesis is that a strengthening dollar is actually going to cause its own destruction at some point, or its own demise at some point. Do you want to talk a little bit about that?
It's like taking steroids, right? It makes you stronger in the short term, but it ultimately kills you.
Right. Okay, so explain this. How does this happen? What does it look like when the strengthening dollar causes its own demise?
Well, I think what probably happens is that it doesn't happen right away, right? But I don't think it takes much longer for the pain to start showing up in other places around the world. So let's just assume for a second. Listen, I could be very wrong on this, but for now, let's assume that I'm right. That rates start to rise in the U.S. The Fed continues on its path of raising rates, and we start to get a little bit of inflation in the U.S. as a result. Okay, so if we take that as a assumption for right now, I think the pain starts to show up in China very quickly. I think the pain starts to show up in emerging markets very quickly. I think it's not too long in Europe before they start to feel pain as well, because they've got a number of problems, Greece and Italy being two of probably the biggest ones, not to mention dealing with Brexit. And so what I think happens is the dollar starts to escalate in price pretty quickly. And I think what happens is you start to get, and this is what I actually think a couple of Trump's cabinet picks have made comments about how the strong dollar could hurt us short term, and the dollar actually sold off on that news. And he said something like, at one point he said something like, it's nice to have a strong dollar for bragging purposes, but for other than that, it doesn't really do us a whole lot. So there's all this innuendo that Trump wants a weaker dollar. Well, I actually think he has more negotiating power with a stronger dollar And I think I think these foreign countries and these different trade groups, he's talking about getting us out of these different these different trade treaties. I think, these trading partners are going to start to complain about the strong dollar. And I think the IMF will probably start to complain about the strong dollar. Without some kind of a policy, and not just talk. Trump can say something and the dollar might trade down for a couple of weeks or a month or so. But unless he actually does something to weaken the dollar, the market's going to react and it's going to rebound. But I think it doesn't take much more than a year or 2 years before a bunch of the trading partners, a bunch of, the IMF, some of the monetary authorities start to, really talk about how the strong dollar is not conducive to world trade and world growth. And they may even have another Plaza Accord type. I think without them having some kind of a Plaza Accords type agreement or some kind of a coordinated, devaluation, everybody devalues against gold or something like that. I think it just goes until the strong dollar bankrupts the world, and that's why I say I think the dollar and gold rise together. As these problems start to pop up, I think gold and the dollar start to rise together. It's kind of a safe haven flight to both of those assets. Ultimately, the dollar debts will have to get bigger during all of this as well, too, right? I mean, for a velocity of money to pick up, debt has to grow. We're already way in over our heads on debt, so, the debt will have to get even bigger. Eventually, people will realize that debts can never get paid off. The currency in which all these debts are issued is going to have to be worthless, and that's when, gold separates itself, and maybe at that point, people give up on fiat currency altogether, and then maybe we go from the deflationary or the strong dollar to a weak dollar because people just flee the currency. So that's how I kind of see it playing out. I would think that in the next 12 to 24 months, the strong dollar is going to really start to hurt the global economy. And I think they will probably. I think initially they will try to do kind of these little small half measures at best. And they'll try to talk it down. But I think eventually they're going to have to do something more dramatic and permanent in order to combat the strong dollar. Here's the great thing about this argument. If I'm completely wrong and they reverse course and they try to inflate the way the dollar right now, I own a lot of gold, and that should do very well in that environment as well. So I think, a lot of times when I think it's my job to try to stay as impartial as possible to what's going to happen and try to figure out what's going to happen. And it's all about probabilities. And even if I think the probability of something happening is only 1%, I think it's part of my job to figure out, okay, so we know that we think there's only a 1% chance this is going to happen. But if that 1% chance was to happen, what would have to happen for that 1% to happen, right? And I think part of my job is to kind of think through that and really focus on that 1%, even though I don't think it's going to happen. So if that does happen, I'm not totally caught off guard, and I kind of understand the reasons why it's doing that. And I think that's one thing I would recommend to anybody is I think sometimes it's very easy to get caught in an echo chamber. It doesn't mean that the echo chamber is wrong. The echo chamber that you're in may be 100% or 99% right? But you don't learn a lot in the echo chamber. You can learn a lot by listening to that 1%. Even if you vehemently disagree with them, listen to that 1%. Try to figure out where they're coming from and figure out what kind of crazy scenario would have to happen for that 1% to happen. Mm-hmm. That way, if it does happen, you're not totally caught off guard.
I agree. Outstanding. You know what, Brent? I think we've got a new nickname for you. You are the 10th man. Because I don't know if you've heard of the 10th man principle, but the idea there is if there's a board of directors and the board consists of 10, that's not likely. Let's say it's 11. But let's say everybody on the board, 10 out of the 11, like if you'd be the 11th man, 10 out of the 11 all think one way. It is your duty to disagree and take the opposite position, right? So I think that's really great about the way you look at things and look for things that everybody else really isn't looking at. And so this has been a really great discussion with you today. I want to be respectful of your time, and I really appreciate you taking the time to talk to us about these things.
I appreciate you inviting me to come on. I love talking about this stuff. Listen, I've been wrong a lot of times in my life. I'm going to be wrong a lot more times. So, I like talking to people like you and others that, can agree with me on some things and disagree with me on some things. And, just talking through it really kind of helps crystallize some things, but it also helps, figure out where you might be wrong in some things. And I think the one thing I would say is, when I really started studying this stuff and really started digging in, the reason that it brought me to gold, and I know you probably agree with this as well, and is that regardless of which way this goes, the flaw in the monetary system exists. I mean, that is a fact. It's a mathematical fact.
It's math.
And regardless of which way it goes, whether it goes south because of the deflationary forces or whether it goes south because of the inflationary forces, gold cannot be deflated away and gold cannot be inflated away. Gold's a constant. It's an element, right? And that is the one part of your portfolio that regardless of which way this resolves itself will still be standing at the end of the day. And I think that's why it has to be the anchor of everybody's portfolio, regardless of which way you think it plays out.
Totally agree. Brent, thanks so much for being with us today. Greatly appreciate your time, and we'll have to do it again sometime. And with that, John, I'm going to hand it over to you.
Well, thank you indeed, Brent Johnson, for sharing your insights with us today, and thank you, Alex Stanczyk. And most of all, thank you to our listeners for joining us in this first episode of Global Perspectives. Let me encourage you to follow Brent and Alex on Twitter. Brent's handle is Santiago AU Fund, and the Alex handle is @Alex Stanczyk. So goodbye for now, and we look forward to joining you again soon. You have been listening to Global Perspectives with Alex Stanczyk, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Alex Stanczyk and other thought leaders in the fields of geopolitics, economics, and the global monetary system.
And whatever you buy doesn't go up, then the equity gets eroded and you have to resupply the collateral or else the whole account fails. It's very similar. If GDP and money velocity is not high enough that there's not enough transactions going on to satisfy all those interest payments, well then the Fed has to come in and plug the hole and add money back to the collateral, which is the base money. And so and so that's really the stock and the flow. And if you look at the velocity of money, it really started in the late 90s, probably around, this would be a great question for, Jim Rickards, who I know you're very close with. It all started around the 98 crisis when long-term capital management, the Russian debt crisis, and the Asian currency crisis. Mm-hmm. You can look at the velocity of money, and going back there, it's just been on a downward slope ever since then. Now, there's been a couple times where it, turned back up for a year or so, but then, just turned right back down, and we've been in this downward motion for 15 years now, 16 years now, almost 20 years now.
Yep.
And you can go back and you can look at the reserves at the Fed and the base money, and it's ramped up since then. And there's a direct correlation. If money is not moving, then they have to continually fill up the collateral, and that's the essence of the stock and flow. That's the essence of the flaw in our monetary system. The other part of it is that if the money is circulating and there's no problems, the interest attached to it, even if it's just 1% a year, it becomes an exponential system. It doesn't matter. You can start with number one. If you take 1 times 1.01 year after year after year after year, it will eventually go exponential. It'll turn straight up, and it'll, and then you get the inevitable blow off top that ends with a magnificent crash, right?
That's the hockey stick on the chart, right?
Right. So, exactly. So it doesn't really make sense. All loans have interest attached to it. So if you loan money into existence, then at the end of the year, you need more money to pay the interest than actually exists. So either the existing money in the system has to be circulating, or the flow, for lack of a better word, has to be flowing at a fast enough rate where that money can change hands and satisfy everybody's interest payment. If that flow is not flowing at a high enough rate to where the interest gets paid, then loans go into default, and because it's like a daisy chain, it starts cascading all the way back to the base money from which that money was loaned into existence to begin with. You look back at all the central banks are like this. They're all kind of based on the same design, but for this argument, let's just look at the United States. The monetary base is around $4 trillion, about $2.5 trillion, or actually it's about $2 trillion. $2 to $2.5 trillion is reserves at the Fed, which isn't flowing. That money just sits there as a reserve, the bank's reserves. Then there's about 1.5 million of physical currency, which actually, so that's money that actually exists. That's the base money. All the other money is basically digital money, ones and zeros that are loaned into existence, and it shows up on a ledger somewhere that says you have this money, and et cetera, et cetera. And so, if you look at the total banking system, the banking system has, again, it depends on how you measure it. Let's just say $15-16 trillion of banking assets. So if 4 trillion is base money, then that means there's 12 trillion of money loaned into existence, and some other assets, et cetera, et cetera. So anywhere from 10 to 12 trillion is loaned into existence. So there's interest attached with that 10 to 12 trillion. And
right. A lot of interest.
If that's right, so if that money isn't circulating, those loans go into default, and you can think of it similarly like a collateral account on a brokerage account. If you buy on margin,
devotes himself to educating the public on financial and monetary issues, and his work is often featured throughout the blogosphere, including Zero Hedge. Welcome, Brent.
Hi, guys. Thanks for having me. It's great to be with you today.
And now, Alex, over to you.
Okay, thanks a lot. So let me start out by saying, Brent, it's really great to have you on. One of the things that I find really interesting about you is that you don't really follow the crowd. There's a lot of different analysts in the space, and interestingly enough, and you're probably already well familiar with this, sort of the common theme or the common thing that you see amongst analysts in the sector is that they all often parrot each other. And I find it kind of curious how that happens, and it isn't so often that you run across someone who's got some original thinking and some original content, and you definitely sort of fit that mold, or you're sort of the person who, I shouldn't even call it a mold, you've broken the mold, who really kind of looks at the whole situation in your own sort of way. So looking forward to what you have to say on a lot of these different levels. If you don't mind, Brent, let's talk a little bit about your latest presentation. Is called Don Yuan. Can you give us like a really quick summary of Don Yuan and what it means to you?
Sure. Yeah, and thanks for the nice words you said, by the way. I'm excited to be able to come in and talk to you, and I've been a fan of your work you do as well. So this is a great opportunity. As it relates to Don Yuan, it's really a play on two of the biggest forces I see in the world today, and it's not just market forces, it's political forces and it's social forces, and that's Donald Trump, the Don, and then China and the Yuan. So rather than Don Yuan, I kind of titled my latest presentation Don Yuan, because I really do see those as being the two primary forces right now. And it's kind of a funny play on words, but it's actually a pretty serious topic when you really get down to it. And it's a very divisive topic, but it's an important one. So that's a long way of explaining the Don Yuan title, I guess.
I understand. Let's dig a little deeper sort of into some technical areas that you had mentioned in your other series, Step into Liquid. And one of the things that you talked a great deal about was stock and flow of the money supply. And a lot of people are familiar with this concept of stock and flow, but they may not really understand why the flow part of the stock and flow is so essential and why it plays such a big deal in sort of your framework of looking at the world. Can you talk to us about that, about why flow is so essential?
Yeah, absolutely we'll do that, because it's really kind of the key to everything. And it's funny because I kind of learned this stuff in college, but I probably just learned it long enough to memorize it, to pass whatever test I was taking, and never really thought of the real world implications of it. And then, 10, 15 years ago, I started looking at it closer, and 10 years ago when we started getting into 2007, 2008 timeframe, I took a really hard look at it, and that's when it really hit me. So the stock and the flow really goes back to a debt-based monetary system where money, for lack of a better word, is loaned into existence. And the way that our monetary system is designed has a severe design flaw in it. And you can argue whether or not it was done on purpose or whether it was done on accident. We could probably do a whole hour just on that. But regardless, the flaw is there. Yes. And the flaw is that in a debt-based monetary system where money gets loaned into existence.
Physical Gold Fund presents Global Perspectives with Alex Stanczyk and invited guests. We'll be exploring international markets and the complex forces that drive them, including geopolitics, economics, and the global monetary system. Hello, I'm John Ward on behalf of Physical Gold Fund. We're delighted to welcome you to the first podcast with Alex Stanczyk in the series we're calling Global Perspectives. Alex Stanczyk is the Managing Director of Physical Gold Fund. Alex is an expert in the physical gold industry, dealing with the logistics chain from refinery to secure transport and vaulting, and he's lectured globally to investor, institutional and government audiences on the role of gold both in the international monetary system and in investment portfolios. Hello, Alex.
Hello, John. Great to be here. This is going to be a wonderful conversation today with someone whom I'm a big fan of personally.
I'm sure it is. And our guest indeed today is Brent Johnson. He's the CEO and portfolio manager at Santiago Capital, a hedge fund that focuses primarily on bullion and other metals-related investments. Brent has been creating and managing wealth management strategies for high net worth clients since the 1990s. Early in his career, he was a financial auditor for Philip Morris Management Company, and he went on to serve private clients for Credit Suisse. Brent recognized early on the need for a robust precious metals solution for his clients, and that's what prompted him to launch Santiago Capital. Since then, he's attracted a growing following as an expert on gold. Now in his spare time, Brent devotes